Just yesterday, a premium member of my Unrivaled Investing community asked me, Daniel, do you think Humana stock, HUM, is on sale? So first of all, my initial reaction was, big insurance company, probably too hard. And then I saw that the stock dropped another 15 to 20% today. So I'm like, okay, maybe I want to learn a little bit more. And zooming out, it's lost over 50% of its value in just this past year. So is this now in deep value territory? This video is going to be less about the deep dive into Humana and whether or not it's a deep value type of situation, even though I am going to cover why did the stock drop today. It's more a video and more of a focused on education, thinking about your process as an investor when you are looking at new companies, because I think it's important to reflect that every investor has a different type of journey. How should we and where should we even start when we're looking at Humana? And it's important as I talk repeatedly, different journeys. When I first started out investing, my focus, I recognized that I didn't know a lot and I was just learning and I was reading. And so I set my own guardrails to protect me. And so I focused on, okay, let's buy things near liquidation value because, hey, unless the cash gets burnt up, if you have some sort of backstop with liquidation, that obviously works. It has its advantages, but it also has disadvantages, and that you can't really scale that up significantly. Whereas I also realized that it's a lot more fun to buy and hold things over a multi-year perspective. It's also more tax efficient if you can find things that you could sort of partner with over a multi-year perspective. Hey, can you get growth? Can you get valuation expansion? Can you get the free cash flow that goes to you as a shareholder? So for my own personal journey, I've evolved to find companies that, where I can enjoy the process. I can enjoy the journey and hold ideally for years at a time versus just turning over rocks, buying something, then selling it maybe if it gets revalued a year later. As always, this is not financial advice. And part of my investment journey is to focus now on playing winnable games. That means a repeatable process where you're talking about setting up something where you believe you've set up a framework where the odds are more likely to be in your favor over time. And so, very simple investment type of checklist. I want an aligned management team. I want a compelling valuation or even fair valuation if I get everything else. I want obvious growth potential. And when I mean obvious growth potential, in 10 seconds or less, management has explained it repeatedly. Oh, here are the growth drivers and why we're going to be multiples bigger over time. And it should just bonk you over the head that, oh, this is obvious. Like you could draw it, you could see it in a crayon drawing of like, yes, this is going to be here today and it's going to be there tomorrow, and it's just obvious that it's going to be much, much bigger. Obviously that is most businesses, I'd say, you do not have that sense of obviousness. It's something that you want to jump off the page. A right to win. I'd say the right to win and being obvious, that's kind of what goes with the unrivaled. If you have a business that's truly unrivaled, it gives you the right to win, and then you're going to have that obvious growth. And then one last item that's on this investment checklist is looking for, situations where there's no key blow-up risk, because it's all sort of pointless to say, hey, there's obvious growth and it's a cheap valuation, but oh, by the way, there's this key risk, there's, key customer concentration. And this was another conversation on our exclusive Discord server at Unrivaled Investing, where we are interacting. Hey, what's the level of customer concentration risk that makes you uncomfortable? Every investor is going to have a different journey. Personally, when it's between, let's say, 10 and 20%, it just gets harder and harder for me to hold that position. Because if you have a company where 20% of your sales come from one customer, that customer can start pushing back on you. I mean, because they could say, hey, maybe I can explore other solutions. Or what happens to that end customer? And maybe you lose 20% of your business. And maybe that 20% of your business drives the difference between making a huge profit and being break even or unprofitable. And so that's, it's critical to assess these different dynamics when you're thinking about your own investment journey. This is my own personal investment checklist, with an aligned management being super critical. The compelling valuation is important, but I would say you can buy, if you have something that gets everything else right: aligned management, obvious growth, right to win, low, no real key blow up risks. I could say you could even compromise on valuation, say, hey, I'm going to pay a fair price for it. And it could still work out over time. So looking at Humana, this is the easy part, thinking about valuation. Valuation's typically the easy part. I have a separate course on thinking about valuation. You could check out my website if you're interested. But looking at the numbers, it tells a fairly straightforward story. You're talking about revenue growth over time. However, that's expected to decelerate significantly. These are Wall Street estimates. You can see how it's effectively expected to go to zero growth in the future. You can see how margins have come down a bit over time. Their earnings per share has also drifted lower. And so, you're talking about even after the drop today, where now it's around, let's say, $240 per share, you're really saying, okay, this is maybe trading at a peak, based on peak prior earnings of around $25 per share, you're talking about around high single digits, low teens type of earnings. And you can see they've generated a lot of income over time and sizable amounts of free cash flow. And they've used that free cash flow to reduce their shares outstanding. So you can have a fairly quick story here that you understand, in terms of how the financials are playing out. And also, a ballpark of like, oh, is this company profitable? Yes, clearly this company is profitable. Clearly it's had a reasonable growth trajectory, but it's not growing at a crazy fast period going forward. And you can get a sense for valuation. This is probably closer to the cheap realm of things that you're talking about, single digit type of earnings multiple. And then you also look at historic, let's say, price to earnings multiples, and you can see it's bounced around from, roughly 10 times to 25 times. So if you're buying it around, let's say, around 10 times peak earnings, and maybe it gets revalued in the future to around 20 times, then you're saying, hey, maybe I can have 100% sort of upside. So you're looking at the valuation, and I would say the valuation is saying this isn't bad. That's the first thing. If you want to start with valuation, that's not always where I start though. It's an important, caveat. Some people prefer to do that. So let's understand, why did Humana stock even drop today? So I go to AI Ticker Chat, and chat, by the way, now is completely free to use. So I asked, based on the latest news, why did Humana drop? And it's because there was a decrease in their Medicare Advantage star ratings. So this immediately tells you a lot about the business. So they are providing insurance plans for Medicare. So you're talking about the older population. And this press release called out how only 25% of their members are currently enrolled in plans rated 4 stars and above for 2025, compared to 94%. So that means there's been a huge drop in terms of the ratings of their plans, in terms of how many people are in, let's say, higher rated plans, 4 stars and above, and that this will affect their potential revenue and potential bonuses from the government. And if they use the word bonuses, then you could think, okay, this is going to be higher margin revenue that they're losing, and also could affect investor confidence. Broadly, I look at this as, okay, this is a huge negative. This is a huge red flag. When you're talking about consumers, potentially the government rating saying, hey, the value of your core value proposition is worse than it previously was. And by the way, there's going to be fewer bonuses for you in all likelihood. Now, they might argue that they're reviewing for potential errors in how they calculate it, and it has, there's some appeals process. So, okay, so it's a dynamic situation, but you can understand why it's down based on this news. No one likes to hear like, oh, you're effectively, the value of your services and the ratings has dropped. It's like going to a restaurant, your favorite Thai restaurant, and you're like, hey, I always love getting my Thai curry, a little spicy. And then, one day you say, instead of the A rating, you're seeing the B rating. Well, all of a sudden, maybe you're a little less confident going in there. That's effectively what investors are seeing with this. So then the next question is, okay, clearly Medicare is a big deal for this, but how much, of their revenue comes from Medicare? And so once again, leveraging AI to give me the answer. And it jumps out, 75% of their total premiums and services revenue come from individual Medicare plans. And then they also have group plans, so think businesses, and that's another 6.5%. So you're talking about 80% plus of their revenue comes from Medicare. That is, in my opinion, a red flag. That is a type of blow-up risk that creates significant uncertainty when you're saying, okay, you're dealing with primarily one type of counterparty. Yes, there are a lot of individuals, sub-customers, but that's one counterparty that's going to determine, hey, what is the fair rate that we're going to pay you? And by the way, this isn't going to be a video where we analyze the U.S. financial picture, which isn't pretty, and it's, sizable fiscal deficits. So you have that background for that customer. So it's not like they're going to say, hey, we're going to have plenty of money to splurge in the future and pay Humana extra bonuses. So hearing this sort of setup, it immediately means to me, okay, this is for my own personal investment journey. It's too hard. I would rather find things where I don't have that type of customer concentration risk. I don't have that sort of, one day if you piss off this customer, they can effectively say, oh yeah, you're not going to be getting sizable bonuses, and maybe there's a 5% haircut in your future. This means, in short, that they do not fully control their destiny. And I would rather find companies where you're more likely to be in charge and can control your destiny. And, look, every investor is different. This might work out well. As I already called out, the valuation is not expensive based on where it currently trades. But this is a dynamic where it's just simply too hard for my own personal investment journey. So let's go back to that alignment of management. And, I see quickly ownership percentage for directors and executives is 0.29%. Okay, so you might give them a pass saying, well, wait a second, isn't this a multi-billion-dollar company? Like, this is, it's going to be a small percentage. It doesn't have to be. And that's where it comes down to, if you're an investor, your job is to be like the abominable no man. That's what they used to call Charlie Munger, because he just said no so often. And if you're picky, you're just going to constantly say, no. These I'm going to set aside these key rules for my own investment journey that make me feel more comfortable over time. And that ideally I know is a repeatable process that's more likely to win over time because it has management alignment. I mean, multiple of my companies, it's not unusual to see the investments I'm making where, management CEO owns 10, 20, 30, 40% of the company because they believe in the journey, they believe in the products, they believe in the growth. That's what I want to see. It just makes it easier because they're more likely to anticipate the stressors. They're more likely. If you own 40% of the company, you believe in where you're taking the company. And so it would be extremely unusual to see someone own 40% and be lying and cheating and looking to blow themselves up. I mean, look, it can happen, but once again, it's about playing winnable games. It's not saying it's a guarantee. It's saying you want to increase the odds. And I think you increase the odds when you find those types of situations where you say, management owns a ton. This is not what you're seeing with Humana. So maybe there's some insider buying to take advantage of the stock price falling. And I see there was a loan purchase at a much higher share price of around $200,000. That's really it. There's been a lot of awards, but not really a lot of purchasing. And this was from a director. So this is, at this point, I'm done with Humana. I'm move on to the next company or do more due diligence on the companies that smell right about these other key items in the checklist. If this video talking about investment process through the lens of Humana has been helpful for you, I do appreciate you hitting that thumbs up, hit that subscribe button. Thanks so much for tuning into Unrivaled Investing.